Okay, we're going to get started today by looking at the S&P 500, like we usually do. And you can see that um, we've sold off a little bit since last week. We have um, support by all the major moving averages. We're in upslopes in the 20-day exponential moving average. So that's all a good indication that we're going to um, have positive momentum. Right now, if you look at our meeting notes, you can see that we're starting the beginning of earnings season, and we have we've just had the banks report this past Tuesday, and the big reports this past week have been TSMC and Netflix. So what's happening these days is we've had a big sell-off in the chip sector and chip related stocks, such as TSMC. And yet we have great fundamentals coming from those stocks and earnings reports. So TSMC is actually growing around 60%, and they had a great earnings report, but the stock went down. So we're approaching one of the biggest earnings weeks of the year. We have Alphabet, we have Tesla, we have IBM, Intel, all coming out this week. So I thought it'd be interesting. Hold on for a second. Okay. I thought it'd be interesting to go over some of the chip stocks that have been going down a lot. Um, it seems like there's a lot of babies that are thrown out with the bathwater this week, as they say. So let's look at some of our statistics. The S&P is down 1.5% since last week. We do still have some momentum in the market. We have 60% of the market above the 50-day and 200-day moving averages. So that's good. Um, we have just went into oversold in the S&P short range oscillator. So that's at negative 0.53 right now. So our translation for that is whenever we're oversold, that's a good indication that it's time to start looking for things to buy. All right. So if you can see in our seasonality, we're in one of the better months of the year because primarily because earnings come out now and we have the July 4th holiday. So we expect the good things for the rest of the month. But we look at August, September are traditionally high volatility months, and they usually go down. So you have to be ready for that as an investor. Maybe position your portfolio knowing that might happen. And okay, let's look at the trend lines for the S&P 500. You can see that we are in a well-defined trend line going back more than a year. We're at the 50-day moving average for the S&P, which usually is some kind of support. You can see it's been support for quite a while. Um, so it looks like right now we're a little bit oversold and towards the lower end of our trend line. So our translation is an S&P short range oscillator that's oversold indicates the market is oversold, suggesting a possible rebound. Okay, so right now let's look at our price of oil and or interest rate chart. Okay, so this week we've had the price of oil increasing. That means inflation increases, um, meaning the Fed's leading to increase interest rates. Stock market doesn't like that. And stock market usually goes down at the indication of higher interest rates. Um, okay, you can see the stock market went down in the last week while the interest rates went up. So it's inverse correlation. Um, right now, the price of oil went up around 10% since last week. It's probably about the war in Iraq because we're actively um, bombing Iran right now. So that is making the price of oil fluctuate every day because of that. High oil price is inflationary, so as the price of oil goes up, a lot of times the inflation goes up also. Um, right now, the dollar index hasn't changed since last week, and you see, you can see we're kind of in a pattern here. We've been going up a little bit recently, but in general, we're kind of sideways in the chart. Fear and greed index. We have fear now. It was neutral last week. So our translation is when there's fear in the market, start looking for things to buy. And right now, the amateur investor is bullish. They haven't been bullish in a really long time. So we have a contrary indicator that says take some profits off the table or don't buy. But the VIX is 16 right now. It's 17. It's a very low number. So the stock market really isn't afraid, and it's more of a bull market indicator. And we have fear in the market in our emotional chart. Whenever there's fear, that's when we want to start buying and start looking at things to buy. And when there's capitulation, when everyone's selling regardless of price, that is the time, as Jim Cramer would say, to hold your nose and buy something. But we're not there yet. Okay, so let's look at um, this is the valuations compared to history. You see the energy sector, it's the least valued right now, and the most overvalued are consumer discretionary, industrials, IT. So right now, we want to keep our eyes open for stocks that fall within the quality stocks that fall within some of the sectors that are out of favor right now. Utilities, materials, financials, and energy. If we ever see stocks around those sectors that are quality, that are good long-term buys, we want to start looking at those. But you can see that IT is actually one of the lower valued compared to history. If you see this 47% ranking, so it's half of what it normally trades at. Okay, let's look at the sectors that have done the best so far this year. We've had energy doing really good. Energy is up 28% this year. IT is up 15. S&P Industrials up 14, and real estate up 12, and the S&P is up 8%. So let's look at some of the sectors going up and down today. Hold on for 1 second while I pull that up. Okay, so we have some of the best performing stocks are more in the chip. We have chip stocks such as Marvell, SanDisk, and these are stocks that have gone down a lot recently. So let's look at some of the stocks going down the most. We have a theme, Oracle, down 4%. Oracle is being punished because it has been borrowing money to fund the AI infrastructure. A lot of times when you take on debt, that is not liked by the market. And that's why I always screen for stocks that have a low debt ratio and high cash position. So let's see. I guess the theme for these stocks probably is heavily indebted stocks. Let's look at the ones that are doing the best. We have stocks that are involved in the AI infrastructure build out. All right, that was a good exercise. Let's look at the sectors going up and down the most. We can see the energy stocks doing the best. We have semiconductor doing okay, and technology. The ones doing the worst are home builders. Um, that's probably because, let's look at the 10-year. The 10-year has been going up recently. So you can see this little, when the 10-year goes up, that is bad for stocks that, or sectors that are involved in borrowing money, or so home builders, well, as the price, as the interest rates go up, the affordability of houses go down. That's why you have the home builders going down the most. Biotech, one of the most heavily indebted sectors, needs to borrow money to grow. And as the interest rates go up, the cost of doing business for biotech goes up. And healthcare is going up. So another thing that happens when the interest rates go up like they have been, uh, stocks that pay a high dividend are less in less demand because you have competition with the 10-year. That was a good exercise. Um, okay, so the yield of the 10-year, it has been going up. And our translation is when the 10-year Treasury yield rises, often signals expectations of stronger economic growth with higher inflation. A rising 10-year Treasury generally acts as a headwind for the stock market, and it increases the cost of capital and offers higher risk-free return. Okay, so it was negative for home builders. That's why the home builders were down. And any kind of stocks that are borrowing money, so that includes the biotech sector. All right, that was a good exercise. Let's look at risk on versus risk off. So almost every day we have a risk on or risk off in the market. If you look at today, we have basically it is a risk. Hmm, it's kind of a risk on market. Um, but you have to realize that you have to have a little bit of, risk on, a little bit of risk off in your portfolio so that whatever the market does, you have um, you still perform well. Okay, so let's look at our stock screen for this week. I highlighted a couple stocks that will be doing good in this environment. You can see Micron has been one of my favorite stocks for a long time. It's screening, according to, it says a PEG ratio of 0.11. What I did this week is I sorted by PEG ratio, which is pretty interesting because a lot of stocks that are smaller cap show up in this, but they're less reliable. But I focused on stocks with a high market cap. You can see that Micron has a $1 trillion market cap. We have GE Veranova. We have Phillips 66. This is a refiner, and as the price of oil goes up, refiners benefit from that. And let me see. Okay, so I thought it'd be interesting to focus on some of the stocks that are involved in the chip sector and the AI build out memory stocks this week because we haven't looked at those for a while. There's an article that came out. Um, this was on, I found it on Twitter or X. You can see that semiconductors multi-year PEG ratio, and you can see that SK Hynix, Micron, SanDisk, ON, Semiconductor, these stocks are like at least half priced right now. And I always like to look at stocks like this because you have you have a margin of safety when you buy a stock. So even though they're very volatile, they went down like 30% from their highs. Um, my approach to looking at stocks like this at a very volatile sector is to buy a little bit at a time and hope they go down. So you can see we're going to focus today on SK Hynix, Micron, SanDisk, and we're going to look at NVIDIA. You can see NVIDIA is about half off, and these stocks are like maybe 10 times the price they should be. So let's look at an article here by Yahoo Finance. It says the memory stock sell-off created a strong entry point, says Morgan Stanley. Investors are buying in. And so Morgan Stanley analysts argued the sell-off has created a strong entry point to stocks such as Micron and SanDisk that, despite double-digit declines in recent weeks, are still worth at least 3 times what they were at the start of the year. Okay, so that's a good hint. When I read an article like that, that's a hint, but you got to do your own research whenever you read a story like that. So let's look at our, let's do a review of Micron and a couple of the other AI infrastructure memory build out companies. Okay, so Micron right now, if you look at their earnings they grew 800% last year, which is just amazing. But this year, they're scheduled to go 110%. And their forward PE is only 5 right now. So it seems like their PEG ratio is 0.05, which is 20 times undervalued. So their profitability is off the charts and return on equity is great. They have more cash than debt, so that's not an issue. Um, if you look at what CFRA said, they said that the fair value is 3,893, which is 352% undervalued. But CFRA says they're about fairly valued where they are right now. So let's look at some other stocks. Let's look at SanDisk. Right now, they're scheduled to grow at around 210% from this year to next year, and 18% the year after. Right now, their PE ratio is 21, which is quite higher than Micron. So if they're growing at 21, if they're growing at 210%, that means they're about 10 times undervalued because their PE ratio is 21. You divide 21 by 210, that gives you 10 times undervalued. But their profitability and return on equity are off the charts. So that's 4 times what we're looking for. And they have more cash than debt. So that's another stock that seems like it's undervalued. CFRA says the fair value of SanDisk is 6,300, which is about 368% undervalued. Okay, so that's a good hint that um, the stock is undervalued. Let's look at SK Hynix. There's not as much information. I couldn't get a good report from CFRA or Morningstar, so we have to wait for that data to come in. Right now, we can see from the sketchy information we get from Yahoo Finance that they're growing about 40%, which is not as great as the other companies, but their PE ratio is only 7. So still 47 divided by 7, they're about 10 times undervalued. And you can see their profitability is off the charts. So we still have sketchy information for this company because they just went public and they're an ADR. Um, that means a stock that's listed in another country and that it's double listed here. I thought it'd be interesting. So the way I'm approaching this sell-off is I'm buying a little bit at a time as these stocks go down. So that's called dollar cost averaging. And you have to have a lot of guts to keep buying as the stock goes down. But if you buy a little bit at a time, um, then it makes things a little bit easier for you if it keeps going down. Okay, let's look at some other stocks I thought were undervalued. I didn't do a whole report on each of these, but this gives you an indication. Western Digital, they're they're about a PEG ratio of 0.42. That means they're about half priced. This is Seagate. They're about the same valuation, about half priced. We have NVIDIA. They are also about half the price they should be. Their forward PE is 23 and they're growing around 40%. ON Semiconductor, they're about one third the price they should be. All right. So right now there's a lot of fear in the market. And if you take the big picture, you have about drawdowns last a very short amount of time compared to the time when the stocks are going up. So you can see that you can make more in bull markets than you lose in bear markets. So I guess the conclusion to this story is whenever the stock market goes down a lot, you got to focus on watching the fair value of the stocks that you're looking at and focus on dollar cost averaging and putting a little bit at a time in the quality stocks as there's opportunities. Um, that's all I had to say for today. I hope you enjoyed that. And I'll see you next time.